Hey guys, this is Sean and my good buddy Sash here to talk to you on the Firegrinders podcast. Excited to be with you today.
Welcome everybody. We're really excited to bring you some awesome new content, and today we're actually going to start getting into the meat and potatoes of it all. We're talking about index investing today.
That's right, the fun stuff.
It has been a really long time since we've actually published any episodes, so we do want to apologize for all our listeners waiting for new content. It has been a couple crazy weeks, to be honest.
Yeah, a couple weeks. I know everybody's at the edge of their seats. They're just waiting for new stuff. Literally somebody that hasn't moved from their chair out there somewhere waiting for us to come back.
Absolutely, right? Yeah, totally. By the way, we were chatting earlier, Sean, about how we can try and build some more engagement. And we mentioned like chat groups and potential live streams. What are your thoughts about that? And what do you think the audience would like?
I love the idea of it. I think what you have going on your other set of streams is amazing. You have a sense of community that's built up around it. And I would love to see the same thing on this. Maybe you guys let us know what you think. Would a live chat group work for you? Would you join in if we figured a time that works well for everybody? And you could ask questions live as we go, add comments as we go. We could have a sense of dialogue going. I really do love that idea. I think it'd be a lot of fun. But I defer to you because you've actually got this going already. So the sense of community that you've built, you're the architect of that. And I think that'd be a fun element to what we do here for sure.
I mean, it kind of occurred to me as I was going through this whole live stream process for the past, 31 days. I've literally been doing this for a month now. And I've been...
Congratulations. That's a big landmark.
It's crazy because...
That's awesome.
Every bit of value comes from the community. Like I'm just the guy presenting it every single day and just being consistent with documenting it. But lots of the value is actually made up of the community. And I have to say that on my YouTube live streams I think we actually stream cross-platform. We've gotten to like 10,000 views in like the space of 20 days or so. It's crazy.
I love it.
It's crazy.
That's great.
It's crazy. To just think
that level of enthusiasm,
Yeah. And there are people active in there every day. We have like thousands of messages going back and forth. And so I think, building a community around this particular show would be really, really great, as well as give people in the audience a better opportunity to interact. And I think that's what it's all about. So it's really cool.
Absolutely.
All right. So cool. We're talking about index funds today and index investing. Of course, I'm sure there are lots of people out there who probably have never heard of this, as well as lots of veterans out there who probably have. What is an index, and how can we wrap our heads around this concept?
So we're going to get into the meat and potatoes of what index funds are, what makes them up, what differentiates them from other kinds of funds, and all of that. But as a general concept, index investing was started back in the mid 1970s. John Bogle gets a lot of credit for being the first architect, if you will, of index investing. There were actually index funds prior to that, just not available to the public. I think a lot of them were used in pension funds and things like that. But John Bogle had the idea back in 1975, first to form the Vanguard Group, which you guys have probably heard. And in 1976, a year later, he formed the first index fund that's available to the public. And that was one that's structured around the S&P 500, or the Standard & Poor's 500. Which is a market index that's basically made up of the largest 500 companies in the U.S. stock market. So we're going to get into a lot more about what an index is, what the funds do that emulates that structure, and what makes them different from other funds a little bit later. But just as a general introduction to index investing, that is where it started. And John Bogle has, if you guys haven't heard of John Bogle, look him up, pick up some books of his. Warren Buffett said he's done more for the individual investor than anybody in the industry, and I'd agree wholeheartedly. He is my personal hero in the industry. I look up to him immensely, and I had the extraordinary good luck of picking up one of his books as my first investing book ever, and it changed my life. So awesome. It's really, really good stuff out there. But where did you first hear about index funds, Sash? Have you an extensive history? What's your story? Let's get into our stories.
Sure. I mean, to be completely honest, I got into mutual fund investing in South Africa about 8 years ago, give or take. And they were just privately managed funds. So basically assets under management from the banking institution that I personally invested with. And they did not track the index. In fact, there were no products. There were no products.
None?
Based on what I was exposed to, or what I had access to, that actually tracked the index. They were just assets under management. They would pick the stocks for you. They would allocate funds for you, and they charge crazy fees.
No doubt.
So I had no idea for almost a decade, to be honest. I probably found out about the S&P 500 like maybe 3 years ago. And by then, obviously just watching YouTube videos mostly. And then started obviously reading a lot more about them. But I never, personally, to date, have never invested in an index fund. Can you believe it?
Never? Well, we're going to change that. Hopefully we'll we'll get you a little oriented on.
In fact, after we had pulled our assets out of our South African mutual fund investments because they were just doing a terrible job. Please, people, it's just a general public service announcement to all our listeners out there. Please never just trust what your banker or your fund manager or banking institution advisor says. Always just read the fine print. Always look at the fees, because you can and probably will get ripped off like I did.
Absolutely. I'm sorry to hear that it happened to you, but
for the longest time. And so my wife and I, a couple of years ago, we actually decided, about 3 years ago, when I found out about how index funds work and how you can completely scale your income just through compound interest. It was just the craziest, most attractive thing for me, especially considering the fact that it tracks the index. It's not something that people are going to individually pick because people can obviously make mistakes, and the indexes have proven over time to outperform individual stock pickers or fund managers. And so,
human capital does not go anywhere near as far as you think it does. Like that's one thing that I've learned is like the people that tote themselves as professionals that do this, they live, they breathe the markets, they're still beholden to it. They don't have as much skill or control over your investments as they'll have you believe. And that
absolutely. And it's all marketing and sales at the end of the day too. They just want to make that sale. They just want to get that client or that customer and get that commission, because that's really what motivates and drives them. They are salespeople, and they're going to have you believe anything just to sign that contract.
Absolutely.
And put your funds.
And so that, for me, is like a huge motivation. Is like, I want to undercut that. You know what I mean? Like I see that happening. I see that kind of predatory practice in the industry. I see people trying to create and manufacture this complexity just so they can catch people and take those investments and pretend that these are stormy waters. You don't know how to navigate them. I will. I have a specialized skill set and knowledge base and experience and all this that you don't have. So you should be really wary about doing this yourself. Let me do it for you. I'll just take a cut of whatever your earnings are. It's manufactured. It's predatory. And I love the idea that we're getting out there and we're undercutting that.
Absolutely.
That we're showing you, we're two average guys, right? We don't have any specialized skill sets. We've learned some things over the years, but we're not special by any means. And that's part of my aim in this, is to show people how within reach it is for you. There's nothing overly complex. It does take a little bit of learning up front to get your feet on the ground. But after that, you're going to see how simple it is and how achievable it is for you.
And we just want to make sure that every person listening to this is empowered to take control, because you absolutely do have the power to take control of this.
Absolutely.
And that's something that institutions don't want you to believe. You know, as a retail investor, you actually do have the power to manage your own portfolio very profitably. You don't need to pay 3 to 5% off the top. It's just, you know, you don't need to.
It's crazy. Yeah. And when you look at the numbers compounded over decades of what that 3 to 5% looks like, it's incredible.
It's terrible.
Like I did a cost analysis on one of my blog posts and looked at, you know, just the average active fund, the average active mutual fund compared to the average index fund, and the cost, the amount of your profits that are eaten up with costs for an index fund is about 1%. So 1% of your profits go to costs over about 30 years. For an actively managed fund, that number shoots up to 42%.
Oh my gosh.
42% of your profits are gone to someone else's pocket.
Whether they make money or not, and that's the crazy thing. So here's our unfortunate story, and this is kind of what propelled me to like just get into like a higher risk, higher reward type of vehicle, which is cryptocurrency. Over the 8 years that we had been investing, we got back less than our principal. This is like, wow. That means that all of the promised interest compounded over time was eaten away by all the fees, and we got back less than our principal investment. Can you believe it?
So I can, unfortunately, but my question for you is how much of that was that 8-year window was this particularly volatile period of the market? Was it abnormal? Was it a really bad time in the markets you were in?
Yeah, look, I mean, like we started this late 2013, early 2014, and then obviously just recently. So the biggest volatility happened last year during the coronavirus, COVID-19 lockdowns. And so obviously that's where the markets across the globe just plummeted. I imagine that did impact our portfolio significantly, but still, you know, like I wouldn't imagine it would erode all of our interest over an 8-year period.
And that's why I was asking the question is to give people an idea. The markets are volatile, but even through volatility, with a properly structured portfolio, you'll still come out ahead. You'll still make money. You shouldn't be getting less than your principal over longer term time periods and this and that. But exactly what you're talking about, like costs and improperly trusted skill and all those things can erode the money away. You know, and here's the thing. I may have a very similar story to you, but my position is probably even worse because I don't even know it. So meaning my wife and I have been contributing to retirement accounts for years, right? We've been putting away money, just kind of putting it into the account, letting someone else manage it within the accounts themselves, not paying attention to what that money was doing, just knowing we were saving, you know. But I was never tracking it. I never understood what it meant. I was in a position where we were just putting money away blindly. I didn't even know what stocks were, what bonds were, what mutual funds were, what investment selections we were in. I couldn't have told you anything about our asset allocation. So we very well may have been in a situation, and I know for a fact we were in some actively managed funds with these accounts. We very well may have been in a situation similar to you where we actually lost money over the years and I just didn't even know about it. So at least you were aware that you were losing money. I didn't even know. I can't tell you to this day what our portfolio was doing because it just wasn't on my radar, you know?
But like, you know, like think about it. How many people out there could be in that same scenario, that same situation right now, you know? And it's just so frightening because it means that somewhere within this whole pipeline, some people, probably the managers, are getting the biggest cut. Like that's where the biggest reward is happening, not to the end user.
They take their cuts regardless of whether you make money or not.
It's just
so you're right.
Yeah, it's terrible. That's terrible. And so, of course, I guess our message is awareness first and foremost. You have to know. You have to know your numbers. You have to know how your portfolio is doing. You have to absolutely take control, because if you don't, you are going to get ripped off, especially in the financial markets. It's just, it's the most, in my opinion, just based on my experience, it is the most cutthroat of all the markets. It's just
I agree.
so dangerous, and it can absolutely ruin your life. even if you think you are fine and you're investing and you're set for retirement, it can ruin your life if you have no idea how things are working. And so hopefully today we're going to take you through some important steps, some important principles to consider. Sean has, by the way, if you haven't checked out the FIRE.net blog, that's where all of these articles are found, and you have free access to that. So just go ahead and check out that link in the description, you guys, or in the show notes, and you'll be able to find all the content that we talk about here. Again, totally for free. You don't have to pay anything to access this information. We just want to make sure more people out there are empowered. And so, Sean, why don't you walk us through part 3 of your investing guide here, which is an introduction to investing, index investing specifically. So we've already mentioned that, it kind of tracks the index. Let's just kind of talk about what is an index to start out.
So an index is basically a way of tracking a market or a particular section of the market. So you have all these different indexes. You've heard of the NASDAQ is a popular one that tracks mostly technology stocks. As I mentioned earlier, the S&P 500 is one of the most popular. That basically tracks the top 500 companies in the U.S. stock market, or 500 thereabouts. It's never exact, but right around 500 of the largest companies in the U.S. stock market. The interesting thing with that one is the S&P 500, because those companies are so large and influential, they account for something about 82% of the entire stock market. So you think about those 500 companies, if you look at the entirety of the market and you look at the value that's assigned to each company, those 500 companies take up about 82% of the entire value of the stock market, which is just crazy, right?
Yeah.
So a lot of times people look at an S&P 500 fund, and like I said, this was the first fund that was ever created, was a fund that basically mirrors the S&P 500 index. And we'll get into fund structure and exactly the differences there in a second.
How old is it? How old is the S&P 500?
The S&P 500 itself, the index?
Yeah. The index.
That's a good question. I know but I'd have to look at the stats to see how old it is, but it's been around quite a long time.
Are we talking decades or?
Oh yeah.
Yeah. Okay. Yeah. Perfect. So that's actually an intentional question, because that shows that we're able to measure performance data over a very long period of time to determine performance, profitability, and potential projections, right? And so
1957. Just looked it up real quick.
Crazy.
So think about that.
1957. It's older than we are. That's crazy.
Oh, easy. Yeah. Absolutely.
So that's kind of like the point of mentioning this, is that these are vehicles that are quite secure, quite trustworthy, you could say, to an extent. But let's unpack them a little bit.
Sure. So his quote that you're referring to is basically that index funds make the most sense for the average investor. He stands by that. Even though Warren Buffett is obviously someone that's made him his livelihood and his reputation off of investing wisely in an active manner, he still recognizes the rationale behind index funds, the fact that it makes the most sense for the average investor. We're going to get into a lot more of that information, some of the studies that show why exactly it makes sense for the average investor, some of the comparisons between the options you have for investments, and why index funds are so compelling as a strategy. We're going to get a lot more in depth with that in future episodes. But he put his money where his mouth is. He actually put up a $1 million bet against Protege Partners and their chosen hedge fund. And he basically selected the S&P 500 index fund to see how they would perform. He put his S&P index fund, Vanguard's S&P 500 index fund, up against Protege Partners' chosen hedge fund, and it outperformed by something close to 5%.
Crazy.
So he put his money where his mouth is and showed that costs are just purely corrosive to an investor strategy, and how much of a difference that could make over time.
Absolutely. What was the length of that test? that he
I want to say
conducted?
it was 10 years. Let me look
10
real quick.
years. Wow.
Yeah.
So it was actually
wanna
a decent sized data sample there. Wow.
Yeah. So he basically put up money in the S&P. They put up money in their chosen hedge fund and outperformed by close to 5% over the 10-year period they were looking at. So, but it's interesting. Yeah. I mean, you look at the history of the index fund, right? And when it was first created for public investors by John Bogle, they actually called it Bogle's Folly was the name of the first index. Not the official name. It was the moniker in the industry for the first index fund that he created, because a lot of the active investors, a lot of the people that are propelled in this industry by self-interest, looked at this and realized that it was going to undercut their profits significantly, and said, this is a foolish idea. We need to try and discredit this right off the bat. Yeah. So they actually nicknamed it Bogle's Folly. And you look at where Bogle's Folly is nowadays, you know what I mean? Or what it's produced. And that is to say that it's taken off immensely. It's a lot more widely recognized today for its merits than it was back then. I think there's a CNBC article that I quote in my blog post that mentions that index funds for the first time in history back in 2019 outpaced active funds. And I think it was $4.27 trillion in assets for index funds compared to $4.25 trillion in assets for active funds. So index funds are really starting to become a competitive thing, and they're actually starting to outpace active funds, because for the first time, people are starting to realize the merits are extremely compelling. And that they enable, like you used the word empowerment, and I think that's a very key word we should focus on, because that's a lot of what the strategy involves is empowerment. Yeah. Is telling people you don't need someone that's out there in this specialized niche in the market to guide you through this. You can actually do better by taking a little time, building a very simple portfolio that's designed for you and your goals and is well diversified and held low cost, and you will have a 90% plus chance of outperforming those professionals out there.
Absolutely.
Think about that. There's no reason not to, It just takes a little bit of time up front to learn, and that's it.
Exactly. So earlier you mentioned like index funds are created for, or an ideal vehicle for like an average investor. What would we consider, like who would that person be? What would fit into that characterization? What is an average investor or an average person?
I would say everybody. Honestly, I can't really think of anybody that index funds wouldn't be suitable for. And here's why. It's because, and I'm not saying the same portfolio is going to be valid for everybody, or the same index fund in the same proportions are going to be appropriate for everybody. That largely comes down to your portfolio structure and your asset allocation. And we're going to get into that a lot more down the road. And Sash and I actually had a good conversation before we started recording today on risk tolerance and on your portfolio's risk profile, and just how important that is to plan your portfolio going forward, because I'm a big believer, and I know you are as well, that emotions and your own psychology are as important, if not more important, than learning this particular set of skills, this proficiency. Meaning that the market is volatile. You're going to run into times of turbulence. And when you do, knowing how to handle those things and knowing how your own psychology is likely to respond, and designing a portfolio that has those things in mind to support your own psychology, your own tendencies, your own risk tolerance, things like that, is key. And so we're going to get into that a lot more down the road. But index funds, I think as an investment vehicle, are extremely compelling, and I can't think of anybody they're not appropriate for. Yeah. The fine tuning for the particular person and the particular goals, the particular nuances of the individual situation, those come from different parts of structuring your portfolio. But
sure. So that's really, really key. So for listeners who are obviously still wondering, okay, so I kind of get the concept of an index fund, but I don't actually know what the point of an index fund is, over just like picking my own stocks. How would you respond to that? What is the benefit of choosing an index fund versus picking your own stocks?
The two most compelling reasons for picking an index fund, and like I said, we're going to build this concept from the ground up. Sure. In our next episode, we're going to start talking about the general classes of investment vehicles that most people talk about when they talk about investments. We're going to talk about stocks and bonds. And if you don't know what those are, it's okay. We're going to cover that in depth in the next episode and kind of build the building blocks as we approach this concept of what an index fund is. So I'll give you the short version of what an index fund is, but if it doesn't make complete sense, we're going to build that concept in your brain over the next few episodes to the point where it's crystal clear. So an index fund, generally speaking, is a type of fund, and that usually means either a mutual fund or an ETF that's designed to mirror a market index like we've been talking about. So sure. If you have an S&P 500 index fund, it's designed in its structure and composition to mirror that market index. Meaning that if the S&P 500 has this number of stocks in these proportions, the index fund is going to mirror that near exactly. And as such, it's going to mirror that performance of that market index pretty close to perfectly. And I say pretty close to perfectly because there are costs associated with any fund. Costs are pretty low with an index fund, but there is a slight difference in return or performance because of that cost factor. So the general idea is an index fund is a fund that's designed to mirror a market index, or some of them even mirror the entire market itself. Yeah. One of the most popular is Vanguard's Total Stock Market Index Fund, which is widely known. It's actually the largest mutual fund in the world. And it's designed to mirror the entire stock market, which is pretty cool because you can buy one share of that thing is like buying a share of the entire stock market. So you talk about diversification potential, and we'll get into diversification down the road too, but that is huge, you know? So
yeah, that's awesome. That's really, really cool. And that's kind of like the point here, you guys, like it's such a convenient vehicle. And that means that, hey, if you don't know which stocks are good, which stocks are not, indexes, are the answer effectively, to at least to a certain extent. And so we're really, really excited to unpack that in the future. Yeah. So how would somebody get started with something like this right now if they're like sold, hey, I do want to try this out. I do want to maybe read a little bit more. I do want to maybe start investing. Is that something we're going to start unpacking in this episode, or are we going to try and do that later?
Yeah, the best place to start is to learn. If you're just starting out in investing, you're eager to get your teeth in the market, you follow the 2 steps we've covered previously, meaning you have an adequate emergency fund and your debt position is squared away, at least in terms of high interest debt. Again, we covered those things in the last 2 episodes. Those 2 things are things you need to square away first. So if you don't have an adequate emergency fund and you have high interest debt, you need to look at handling those 2 things first, or you're not ready to invest, in my opinion. So look at those 2 things first. If you're at the point where those 2 things are dialed in and you're ready to invest, take the time, and it's not a huge time investment, but take the time now to learn. Take the time now, even if it's a month or 2, to sit down and learn the basics, so that you go into the market and you're angled in at the right trajectory for you and your goals. I think the worst thing people do is get on. I'm a member of some of these Facebook groups. People get on and just in investing for beginners group, they'll jump on and ask, hey, what's the best place I can start? And you have all these people throwing stock advice at them, the latest penny stocks or these sector funds or things like that. People don't really know what they're buying when they look at advice like that. They don't really know the ins and outs. They haven't taken the time to learn. Yeah. And I think those are the situations where people end up getting burned because maybe they're getting into something that's highly speculative and they're not aware of it, and they're risking the money they're putting into the market, or they're taking on way too much risk for themselves. And like you said, last year, the S&P dropped 33%. People that just jumped in and kind of were there and had no idea the market could do that freaked out because they weren't ready for it. They didn't have that knowledge base, when we know that the market does things like that, and it does them pretty regularly. But take the time to learn. And we're going to do our best to show you those concepts, to build these concepts from the ground up, to help you get to the point where you have a good knowledge base to use to go forward into the market, and you don't feel like you're overwhelmed. Where you can actually get into these conversations with people and hold your own, and you can say, well, yeah, that's a good point, but what about this? Or, you see some of this advice and that it's not good advice for these reasons, and so really what I've taken pains to do on the blog, and I know we're going to get into on this podcast too, is really building those concepts from the ground up. And today's material was more about just introducing the concept of index investing, introducing what it is, and kind of giving my own story a little bit too, and yours as well, Sash, with your experience, and just showing that we're not coming from any special place. Like I said, if you had asked me 4 years ago what a mutual fund was, what an index fund was, what my portfolio was doing, I wouldn't have been able to answer those questions. I would have had no idea what you're talking about. I would have had to do a lot more digging. And when I started digging, I felt maybe like some of you are right now, just completely overwhelmed. Like looking at these funds and these fund names and the proportions. I had no idea what they were. I didn't know what was going on. It's a really complex world when you're getting into it. Sure. But the thing that I found is that complexity is manufactured. It's intentional, and it's not intended to help you. Yeah. That complexity is something that's built into the market so that people can take their cut of your money. And it's really kind of a scary thing when you realize that's what you're up against, but it doesn't have to be. There's people out there that it will help you. Hopefully Sash and I will help you on your journey. Some of the books I'm going to recommend along the way, maybe you could throw some of the books you've read to Sash in the mix. They're immensely helpful, and will really do wonders for putting your feet on the ground and showing you that this is entirely within your own purview and your own reach. So
hopefully our listeners have gotten the point that they absolutely can do this. I know that some people, we have such a wide demographic of people, like people who are still in their teenage years and people who are in their 50s and beyond in our audience, based on the demographic data that I was looking at recently. It's crazy. And people from all over the world too. And so, we want to come from a place that is very beginner friendly, but also not completely boring to experienced investors. So if we do sound a little slow, or not as advanced as you'd like, just know that is intentional. But we are going to be building towards the more advanced stuff, just at a slightly slower pace, so that we take lots of people along for the ride in case those, in case members of our audience don't have some of those important foundational elements in place yet. And so, let us know actually, what are your thoughts about this in the comment section, or in the show notes section, or when we embed this on our website. Let us know what your thoughts are. Let us know if you're already invested in an index, and if so, which ones are you invested in? We'd love to start that conversation with you, and we'd love to hear your opinions, because hopefully not only are we presenting this information to you, but we're also growing a community, one that is empowered financially. And we really, really, really are looking forward to connecting with you on those levels. So please let us know. Also, we are really excited to bring you some more in-depth information in the next episode. Sean, what are we looking forward to in the next episode?
Like I mentioned earlier, next episode, we're going to focus on stocks and bonds. And we're going to get into, those are the basic building blocks that you'll be looking at for your portfolio. So index funds are basically vehicles that are comprised as baskets of stocks or bonds. And so it's important to know exactly what those are that you're putting into your basket when you buy an index fund. What is a stock? What is a bond? What are the differences? We're going to get into all of that next episode, and hopefully give you a good solid foundation as to what those two things are and how they are important factors in building your portfolio, because they perform very differently when added to a portfolio. So we're going to get into basically the basic building blocks there, and then from there we're going to build this idea of what a fund is, what some of the philosophical differences are that govern how funds are managed. And then go from there into what an index fund is. And then we're actually going to get into the real fun stuff for me, which is taking those concepts and starting to build your own portfolio. Considerations you should lay out before you get started, and how to actually just get into it and start building your own portfolio and doing it the right way. So I'm excited for it. I really am. This stuff is fun for me, and I know it is for you too, Sash. But
awesome. Yeah, totally. Absolutely. Yeah. One more thing before we go, on your site, you've got a link to a document, the FFWF Investing Guide Checklist. What is that? Yes. How can people get it, and how would it help them?
So that is taking the basic structure of my site. The first 16 posts that I'm putting up are what I call our investing guide. And that's basically from the ground up. If you're more of a reader and you want something to supplement a lot of these podcasts, that's a great place to go and look. It breaks down a lot of the information we're covering and covers it a little bit more comprehensively sometimes. Sometimes the concepts we're touching on and then moving on to discussion about. Sometimes in the guide, it's a little bit more in depth. And you can get a little bit more information that way. But the 16 parts are designed to get you from the very beginning, like we're talking about, to the very end, meaning you have your own portfolio and you're managing it yourself. The checklist is a compressed version of that. So it's basically a one-page sheet that you can print out and follow along. You can watch our podcasts and maybe read the guide that tells you the things you should look at learning first. So the first item on there is talking about your emergency fund and your debt position and going down the checklist. And you can rest assured that as you look through those things and you do the research and do the work and you get to the bottom of it, you've taken every step you can to have a well-designed portfolio for you and your goals. So it's just a quick shorthand version of showing that. And I'm glad you mentioned it because that's something that I recommend everyone that's getting started in this process print out and use to follow along as we talk about these things in the podcast. And if you choose to read the guide there on the website, you can follow along there as well. So
awesome.
Just a quick shorthand version of what we're going to be covering, but it'll give you a good idea where we're going and when too,
Awesome. So you guys can actually find the link to that on the show notes section or in the description, depending on where you've got this content. Remember that we are broadcasting across all major platforms. So if you like audio, you can find us on iTunes, Spotify, Google Podcasts, probably Amazon. I'll have to double check that, but you can definitely find us.
We're taking over the world, Sash. Taking over.
one platform at a time. And of course, if you
That's right, buddy.
If you're more of a video person, you'll find us on YouTube and on Facebook. And we're really, really excited to keep this kind of content coming to you as regularly as possible. And so if you find that this is helpful for you, please also share it with some of your friends so that it would also help them. Again, it's totally free, and we get to basically impact more people and help more people become financially empowered, which is our main goal. Thank you so much, Sean. Appreciate.
Thank you.
Appreciate
great discussion.
Yeah, it was really, really insightful. Really, really awesome. Hopefully, we came across as clearly as possible. I just want to, obviously, thank you for sharing that experience. It was just super, super insightful, and I'm very sure that members of our audience will benefit from it. So, thank you.
Well, likewise, yeah. I think we come from a similar place, and I think just knowing that we're relatable to where you guys are at is hopefully part of that aim, just showing you that we're nothing special. We're guys that have learned a few things, and hopefully we can help you to grow, so.
Awesome. So guys, you've been listening to the Firegrinders podcast, and we're so excited to go on this journey with you. Thank you so much for listening. I'll see you in the next episode. Take care, everybody.
Thanks, guys. Take care.